Catching up with you. It was good catching up with you as we were waiting to start this call too. Happy to hear your business is going well. This is the second installation of our webinar series. This is a webinar series that we're going to be doing once every 2 weeks, providing our insights and research on various different discussion points. Some of this is going to be a little bit more research oriented, such as today's topic, the 2026 multifamily outlook. Some of it will be our opinions on what we've seen as well. But we're trying our very best to not be biased as much and really just show you objectively, this is what the market is telling us. In future events, we might be talking more experience related. So it'll be sharing stories, analyzing different projects we've done, problems we've had to overcome, um, different things like that. But like I said, today is going to be focused on the next year and what that holds for multifamily. Before we get into that, I always think it's important to know who you're listening to, and what the credentials are. So you can see some of my credentials highlighted here. I got into multifamily development straight out of college. I was fortunate to meet a mentor who had been there and done that. He was in his mid 40s at the time, had done multifamily development at a high level. And I was just fortunate to be connected with him at a time that he was getting back into it after stepping away for many years. And so I received a lot of one-on-one instruction, got to partner with him on many projects. We started off land flipping, so buying and selling land for a profit, then rolled that into construction. And after about 5 years of working together, I decided it was time to start my own shop. So that's where Surge Investment Group came into play. It was my company. We own about 400 units now across Utah, Texas, North Carolina, and South Carolina. Okay. So, man, I don't know if anyone else can feel this. In fact, I'm pretty sure everyone that has been paying attention the last few years has heard a lot of noise in the marketplace, politically, with various different asset classes. It hasn't been just multifamily, but it's been a crazy time to be an investor. Really, since 2022, we started to see that high value escalation for multifamily in particular really take off, and then 2022 it started to take a dive again. So with everything that we hear, with the election that happened last year, a lot of new policies, things that are going on in the world. Um, how do we, cut through all this noise and identify what actually matters for us as investors? Now, my experiences in multifamily development, new construction, that's where I tend to focus my insights here. I think it can apply to other asset classes as well, but our insights will be shared specifically on multifamily development. So, what actually matters here for multifamily? Well, I think that it really boils down to four primary topics. Now, there's a lot that you can explore within that, um, but for the most part, there's four primary topics here. The first one is going to be interest rate, or in other words, pricing in terms of debt. Obviously, if I can borrow money cheaper, I'm going to be able to either borrow more of it so I can do more and invest more, or I'm going to be able to maximize uh, my cash flows for the fewer investments that I do make. So having reliable and inexpensive debt allows investors to do more, which tends to stimulate the market and economy and creates favorable cycles here for our investment. However, aside from just price, the most important thing is stability. So even if you can see at this chart here on the right side of the screen, uh, in the early 2020s, pricing of debt was very inexpensive. And obviously, those of us that were around investing during that time, saw that it was a very hot market to be buying and selling multifamily. Um, Now you can see from 2022 all the way through 2024, really the end of 2024, there was a lot of instability. So you have really sharp increases followed by some sharp downward trends and then and back up. So it's just kind of zigzagging as far as the pricing over the past few years. But for the most part, it was on a steady upward trend. Um, Aside from the day-to-day instability. So what happened here was during this time, prices really started to dip as far as real estate values, especially commercial real estate values. A lot of the capital that had normally been allocated to invest into these asset classes, whether that be investing in equity to build or buying existing, a lot of that went away overnight. Um, Debt became a lot harder. The few debt options that were still existing became quite predatory. And so if you were going to get deals done, it was at a much higher cost for debt. And really, the only companies that could accomplish deals and fund them were ones that were well established and had a very financially healthy group of investors to be able to fund these deals because more equity was required in this time. Um, so this is a rough time, primarily because of the instability here. Just deals weren't getting done, and so those that had were finishing the end of their identified investment cycle with their investments. You know, you having to either refinance or sell during this 2022 to 2024 period. Um, this ended up not being a great investment window for them. So you have a lot of investors that didn't do well on their performance or had to hold onto their assets, refinance, and still own the property. So expectations weren't met for these investments. So I'm talking about what's happened in the past, um, really for the purpose of understanding what creates you know, more bearish cycles for multifamily, and then what creates more bullish cycles for multifamily. Now, as you can see here, prices tended to, for interest rates tended to stabilize over 2025, even though we didn't see significant reductions for the vast majority of the year. There was stabilization that started to occur, and then we had about 75 basis points in rate cuts by the end of the year. Um, and this tends to be an early indicator as rates stabilize. It's a good predictor that investment's going to follow. There was a lot of investment not happening during the crazy years of unreliable and unpredictable rates. And then once rates become predictable and reliable, more people start to flood the market with investment. And that's what leads us to our expectation here for 2026. There is an expectation in general that rates will go down. I know that the new administration will be announcing very soon who the new replacement is for the Fed chair. I know Jerome Powell is going to be out in May. A new one's going to start. All indications are that Trump is going to be picking somebody that's going to be aggressive as far as getting rates down. But that's not something that we can always count on. So just identifying where we are right now as far as seemingly more stable rates, that alone, without any further rate cuts, will contribute to greater investment hitting the marketplace, which is a good time to be putting in our own funds and investment into these types of projects. Now, moving on to some of these other categories, inflation and wage growth versus rent growth. In 2000 and well, February 2024, from that time on to now, the wage growth has actually increased or been greater than inflation over that period. So that's that's been going pretty strong. And when wage growth is greater than inflation, Usually that's meaning that you have more funds available to the average consumer, right? So they're making more money, and the amount that they have to spend greater each year isn't quite making up for that. Now, for the several years prior to that, that was not the case. There was a deficit there. So that's a good sign. Usually it takes a while for that to really show up in the economy, but it's a very good sign. Rent growth over 2025 actually decreased. So we didn't have any growth. We had a decrease of about 2.9% in the average rents across the United States. So you have wages growing, inflation still growing, but being outpaced by wages, and then rents are going down. So 2025 was a very good year for affordability. I know many might say that it doesn't feel like that, and there's a lot of other factors that play into those feelings, but again, these tend to be early indicators, and you see the signs of that lagging behind them. So I think there's some good things that are happening just from 2024, 2025, and we can expect those trends to continue here in 2026, and we'll expect to start to see some of that those funds flow more freely in the economy here in 2026. Uh, Employment creation is another big one. So the more jobs are created, again, the more income earners you have in a specific market. And when people start to make more money, oftentimes one of the first things they do is increase their housing situation, which also goes hand in hand with household formation trends. So this is going to be how many new households or what is the increase in demand for households over a specific period of time. And the reason these two things tend to play well together is, let's say, for example, I'm a young person that's 25 years old, and I'm living with a roommate that's the same age. Well, we're just out of college, we have jobs, and we're living as roommates because our jobs tend to be entry level. We can only afford to live so much on our own. Well, the more wages grow and the more jobs are created, typically the it's more my marketplace to enter the jobs, and so I tend to be better paid. And the more higher paid people there are in a market, uh, the less people tend to make sacrifices, such as living with others or living at the parents' house or those types of things. And so that's an element of household formation trends. But overall, for household formation, um, we've seen a consistent year over year increase every single year. I don't think there's been a negative year in recent history for new households being created. So there's a lot of demand happening here. The Harvard Joint Center for Housing Studies uh, predicts that by the year 2020, 2035, that 8.6 million new households will be created. So that's a significant increase over the next 10 years of how many households are going to be created. These are all people that will need a place to stay. They will need essentially created households to move into. That's an average of about $860,000 per, not dollars, 860,000 people per year. So let's talk about that demand element a little bit more. Here you can see a couple metrics. The first here is going to be this table to the left. This is going to show you deliveries and absorption. So deliveries is going to indicate new units that are finished being constructed. So they're now created and available for people to move in. And units being absorbed is how many of those units did people actually move into. So if I build, for example, 100,000 units over the course of a year across the United States, at the end of that year, how many of those units are still left empty versus how many are full with renters? Now you can see oftentimes in a high demand environment, the units absorbed will follow closely the units delivered because, for example, if I only built 100,000 units that year, it's going to be really hard for 500,000 units to be absorbed because that's a massive increase over what was provided. Now, sometimes you might see, for example, here in 2015, you had 285,000 units delivered and 300,000 units absorbed. So more units were absorbed during that year than were built. Well, that becomes possible because of previous years' excess. And so you can have slightly above the units delivered and absorption. Typically, you can tell the trends here between 85 and 95% is considered historically to be very good for absorption and an environment where you want to be building and investing in new construction to provide for that demand. Anything over 100% is considered fantastic. It's a market that you want to be building in. And you can see as the years go forward over the last 10 years that the units delivered has steadily increased, but the units absorbed has also significantly increased with that, suggesting that there's still a significant demand for housing, even though more and more units are being provided each year. So again, that goes to what I was talking about on our previous slide on new households being created. This can also be influenced by overall population growth, people coming into the country or people moving from certain areas of the country to other areas and creating more demand within those markets. Now here's a line chart showing, let's go back actually. So you can see the last 2 years, 2023, we had a little bit of a dip in absorption, but in 2024 and 2025 performance, uh, we had a lot of units being absorbed versus even though we were at historical highs in 2024 um, of new units being delivered, those units were still filled up very quickly. So the demand was still there for that. Now, per our earlier discussion of 2022 and 2023 through 2024 of the cost of debt increasing significantly, what you see here is less projects we're able to start. So this line chart will show you an indication here of new starts versus completions. Starts being the blue line, completions, which tend to lag about 2 years after starts because you start a project, it's going to take about 2 years to build. Um, and in 2022, when rates started to spike, less builders and developers could afford to raise the excess equity that was needed to fund those projects and start. And so we have a significant dive here as far as the supply that's being provided in the marketplace. Um, but we know based on the numbers here in this previous slide that the market is telling us that there's still a significant demand that's not being met with our absorption. So we have lowering supply, increasing demand. This creates the environment for 2026 for those that are able to possess units. There's going to be increased demand. Likely, that's going to show by way of increased rents. Because the more demand that you have and the fewer units of supply that you have, the few units that are available are going to come at a premium, right? It's also going to be a very good year to start building new projects because there's been such a lag for the past few years. This demand is going to keep increasing, and our absorption is going to continue to stay at a high rate until we can make up for the last couple of years' lack of new construction starts. Now in hand, this goes to what we've talked about as well. This shows the multifamily price index as provided by Fred. And you can see here in 2000, right around 2007, 2008, uh, where we had the Great Recession, values have consistently risen, but naturally we had a pretty big dip there in overall commercial multifamily real estate values. We had a very strong decade of growth as well, followed by 2021 through the beginning of 2022, a massive spike in values. And then 2022, when rates started to destabilize, that's where values took a significant dip. So we are now in the bottom of this cycle here. Um, 2026, I personally believe is going to show significant recovery again, versus increased values. We've kind of gone through the this destabilization period. We've gotten through the rough patches. Interest rates, now that they're stabling and are likely to start decreasing, I've already seen in my own projects and my own conversations that more investment is coming into this space again. We're constantly having new equity providers reach out to us and say, "Hey, we need to place money. We need to place money," and there's very few options for them to do so. So I think that this is going to really start to improve again here in 2026. Okay. The other thing I want to talk about here is the price of and expectations of debt. So we talked about the nature of debt to overall how the market performs. Um, so where is debt at today? Now, when you talk about debt, these are going to be lenders. Usually, you're going to categorize these into three different categories. And there may be some others outside of this, but the vast majority of capital is going to be sourced from these three. So you have first agency, and that's going to be your government programs like HUD, for example, or Fannie or Freddie. Those are all going to be agency debt sources. The second you have is bank financing. So, or I would also categorize credit unions into this too. Banks and credit unions have an obligation and expectation to lend money, but it's typically going to be very conservative and it's going to be highly dependent on your relationships with those banks or your ability to qualify for their standards. Most of this is going to be recourse debt versus agency is non-recourse. And what that means is recourse debt is going to, if I get a loan from a bank, they're going to want to take a look at my assets and they want to essentially create a lien or a right to those assets if I fail to perform on the loan from the bank. Whereas agency is specifically asset based. So if I fail to perform on the debt on an agency loan, like a HUD loan, for example, the recourse is they get to take over the asset, but they don't go after me personally and all my other assets that are held in different entities and spaces. And then private credit as well is going to be tend to go towards non-recourse, but some of them do require recourse depending on the terms. That's going to be the most expensive debt. So agency tends to be the cheapest. Banks tend to be very cheap too, but require a lot more from you on the underwriting. And then private credit is the most flexible debt out there, but it's going to be also the most expensive debt. Agency right now is going to be anywhere from 75% all the way up to 85%, deal depending and market depending. LTV, which is loan to value. So that's how much money can I get? What's the leverage I can get on this asset? You're 75% to 80% loan to value. You have what's called a DSCR, which is debt service coverage ratio. This is a metric that lenders will look at to determine the health of an asset, and they'll usually lend based on this type of metric. Debt service coverage ratio and debt yield are the two metrics that they really like to look at. Depending on the lending source, they might weigh one more heavily than the other. But most of them are going to be DSCR constrained. And what this means is, for example, a HUD loan has a requirement of a 1.15 DSCR, debt service coverage ratio. So 1.15 DSCR means the property itself needs to be generating income sufficient to cover my debt service, but also have 15% on top of that. So that's the 1.15. So they want to make sure that your property is generating enough income to cover the debt, plus have some margin for error. As well as agency debt tends to be the cheaper option for interest rates. Right now, they're anywhere from 5% to 5.5%, depending on the source. And then you have upfront points. So these are going to be um, your upfront costs for closing and legal fees plus fees that they assess to get something closed. That's going to be roughly 1.5% for HUD loans. Then you go to bank debt. Bank debt is going to be more conservative on leverage, so they're going to be between 60 and 75%. Again, depending on your relationship and qualifications there. They're looking for debt service coverage ratio of 1.25 to 1.3. So they're a lot more conservative when it comes to debt service coverage ratio. And then their interest rates, depending on which bank you go to, is going to be between 5.5% and 6.5% for long-term debt. And then the points that they charge is going to be between 2 and 2.5% is what I see pretty consistently. And then private credit, these are going to be again, the most flexible guys. These are usually the most aggressive ones in the market. Private credit is between 65 and 80% loan to value or loan to cost if you're doing construction. Um, Now, private credit is typically best for bridge scenarios. So it's not going to be your best long-term financing. You want to use it in situations where you're doing construction lending, or you maybe have to get a short-term, 2 to 3 year loan because it's going to be more expensive. You're not going to cash flow as well with this. Uh, you have some private credit options that will go as low as a 1.1 DSCR. Some of them might have a requirement up to 1.2, 1.25 DSCR. Your interest rates are going to vary all the way from 8.5% on the low end, all the way up to 12 plus percent on the high end. And then their upfront points or percentage points that you have to pay as a fee is going to be between 3 and 4%. So they're a lot more expensive to go that route. Now, if you're building or if you're renovating, doing things like that, that increase in expenses can be worth it because you're creating more value. But again, you typically don't want to do long-term lending with private credit options. So let's talk about expectations versus reality. This is where we look forward into 2026 because for the past couple of years, there's been a difference between what banks expect versus what a project actually can underwrite to and pencil at. So today's expectations from debt sources. They're going to, again, the DSCR here is going to be a big expectation. That's going to be typically between 1.2 and 1.25 DSCR on average across these lenders. Whereas most deals today are underwriting with historically with historical expectations on equity. So obviously, if I bring in cash to do a whole project, then my DSCR is going to be pretty great because you're not servicing debt. But let's just call it about 75% loan to value debt. Most deals are underwriting at a 1.17 to 1.2 DSCR. And so we're falling a little bit short on the average market expectations for debt there. For debt yield, most banks are going to want between an 8% and a 9% debt yield. So that's basically how much how much income are you getting as a yield off of the debt? So 8 to 9% is the expectation. Most projects are underwriting right now between a 7.5% to 8.5%. So again, we're falling short. There's a very narrow window of the best projects that meet their qualifications, but it's very few projects. And there's a lot of good projects that you can't get financed under normal expectations because they're not quite meeting those minimum thresholds. Again, non-recourse is usually an expectation for agency debt and private credit, and banks will sometimes do non-recourse if you have a long-standing relationship with them. Well, today, most even private credit lenders are lending and requiring not only recourse but collateral. And a lot of banks are requiring collateral too. So that's allowing them to place specific liens and claims against other assets that you have that are not related to the project you're trying to perform at. So these are a few examples of standards right now being held by the lending markets, whereas projects are not quite meeting those expectations. Well, when that's the case, projects don't get done at a high value volume. Either that, or you have to bring in a lot more equity and initial investment in order to make these numbers work with the banks. Um, Now. moving forward to 2026, uh, I can tell you today where the standards are. It's already significantly better than where we were a year ago today. So banks are getting more aggressive. They're starting to want to do more deals. They're getting more relaxed on the standards that they had set for the last 2 years. I expect that trend to continue through 2026. And so this gap of expectation versus reality is going to slowly narrow. And I think we're going to get to a place where deals start to pencil uh, a lot more than they have over the last 2 years. So you're going to see more investment happening, but also more lending happening, which is going to start to fuel this multifamily investment market once again. Let's talk about equity expectations versus reality as well, because deals are funded with two different components. You have the debt, which we just talked about, but you also have equity. Now, if you are not individually wealthy and have a ton of cash, usually you get equity by raising money from other people. Um, and equity is one of those sources that really has gone dry over the last few years, and again is starting to enter the marketplace again and invest in deals. So most larger institutional equity sources will require what's called a yield on cost or untrended yield on cost minimum. Most of them want a minimum of at least 7.5%. Now, untrended yield on costs, what that means, let's break it down. Untrended means you're not expecting any rent growth. So you're just taking the market rents today, not accounting for any projected rent growth over the next few years for construction or renovations, etc. So that's untrended. And then yield on cost is what what what's your income based on the total cost of the project, right? How much is that project bringing in versus the whole cost? So you would take your NOI, and I think the math is divide NOI by the total cost of the project, and that's what gives you your untraded yield on cost. So that 7% is their minimum. Most deals right now are performing between a 6.5% to 7%. So again, it's a very narrow margin for error. There's a lot of deals that historically would be considered great projects and good locations, but the numbers aren't quite hitting equity expectations. But we are getting closer. And then the IRR return. So this is going to be your internal rate of return, basically an equivalent to annualized percentage with the time value of money being considered in that. Most equity investors are going to expect between 20% and 25% annualized. And most deals right now are penciling underwriting between 12 and 18% at the low end. Now that's going to be untrended again, so this is not accounting for expected rent growth over the next few years. Um, Now, if you get aggressive, you have the low end, which is going to be between 12 to 18%. If things really go well over the next few years, a lot of these investments can pan out into the 30s, even low 40s on some of the underwriting, but you have to be a little bit more speculative in those expectations if that's what you're going to expect. So there is potential for significant upside, but there's more perceived risk right now because it's not what numbers are performing at today. So there's still a gap there. And then most equity investors want cash flow, whereas a lot of deals right now are just breaking even because of the higher cost of debt. So again, with the debt, same with the debt, you have equity, a mismatch in expectations, but I have seen that significantly improve, especially over the past 4 months or so. I expect that to continue to improve in 2026. A lot of equity has sat on the sidelines for the last 2 to 3 years, and they're hungry to get back into the market again. And I believe that they're seeing new opportunities for 2026 with our stabilized interest rates and sound demand metrics. So we're going to see a lot more investment happen on the equity side as the year continues. Okay, so let's talk about market opportunities. What are we seeing that are good opportunities over the next year, and what would we recommend staying away from? So some green flags that we see here. and this is not what I specialize in, but I definitely see an opportunity in distressed asset purchases. So these are assets that are built already. Um, and this is starting to leave the market. There was a really big opportunity for this in 2025 as well. A lot of funds were raised to be able to take advantage of this. But there's a lot of assets that were purchased several years back, and for the purpose of renovating or building. And because of the last couple of years being poor in the multifamily space, they were delivering in a time where it became very difficult to refinance or sell, and so they had to sell at very low prices. So buying these types of assets is there's still going to be a lot of opportunity here in 2026. Value add, which is buying an existing asset, typically older, that has potential to renovate, increase rents, and sell at a profit. There's going to be a lot of opportunity for this. Again, the last few years has not been a good seller's market, and so you have a lot of sellers that want to sell their properties, haven't been able to because of the lack of investment and buyers in the buyer pool. So there's a lot of very well-priced assets right now that are on the market. If you have cash and the ability to go and purchase those assets, you can buy them at what's becoming well-priced debt, good prices with a lot of upside for value add opportunities and immediate cash flow. So that's a significant opportunity that you're going to see here in 2026. If I had, several million in cash sitting on the side, I might heavily consider uh, employing that strategy. The other thing I see here is investing in supply constrained markets. So we showed you earlier some of the supply issues that we're having and high demand. Um, there's a lot of markets that have been overlooked. I tend to focus on secondary markets, which is going to be your tier two cities. So where you have your large cities might be 1 to 5 million in population. There's a lot of cities in America that are growing and might have populations anywhere from 100,000 to 500,000 people, even up to that million mark. That most developers during the heat of the multifamily boom in the late 2010s were just choosing to invest in the larger cities. But you still have significant demand in those second tier cities that we haven't seen that slow down over the past couple of years, even though financially and financing wise, we've had some struggles in the multifamily market. An example of this is I built 214 units and we finished in 2024 in Waco, Texas. And that alone, while a lot of these larger cities were leasing up at a rate of, 10 units per month, this one we averaged about 20 units per month filling. It was this company's management company's fastest lease up in their company's history in the state of Texas. And the reason why we were able to be that successful is because we chose well-located market and an area that was supply constrained and not a lot of people were investing. That those types of opportunities are going to be sound for 2026 when it comes to new construction. And overall, I see 2026 as a good year to start construction again, given the 2 year lag that we've had and drop off in starts. You start something in 2026, you're delivering in 2028, where you're likely going to have a couple years of strong recovery in the market overall. I think timing there will play well for anyone who decides to do that strategy. And then investing in markets with great job density and creation. There's a lot of onshoring efforts right now that's happening with the administration. There's a lot of uh, new companies and new factories being identified for construction, and a lot of those will be creating jobs in areas that are underserviced for housing. And so identifying those types of markets, some of them are in larger cities, but a lot of them are in the secondary markets that I mentioned that already have a lack of supply in those markets. There's going to be some very good opportunities to find great land, build and provide housing for that increasing demand in those markets. Some red flags here that we see are going to include markets with recovering absorption. A lot of the bigger cities over the past couple of years saw a lot of new units being introduced and have had very struggles with absorption. An example of that would be Austin, Texas. Austin, Texas has significantly struggled with their absorption because so much was built in the late 2010s and early 2020s, 2021, 2022, that it's going to take a while for that to fill up. So avoid those types of markets, know which markets those are. Luxury communities, so this is going to be your high-end A+ finishes. That's not going to be a good strategy to get into for the next year, maybe even two. We want to see a lot more recovery in the market before that starts to be an appealing asset class. Um, Wait and see approach. This is going to be over the last few years, you've had a lot of investors just sitting, parking their money on the sidelines in low yield, bonds or CDs or just sitting in their bank account waiting for some sort of opportunity to be created in the market. I'm fairly confident that we're at the bottom of the market, especially in multifamily. I think we're going to see some very strong appreciation in 2026, 2027, and 2028. So continuing to wait on the sidelines is probably not going to bode well for those that are looking for to take advantage of a good investment window. And high leverage deals, it's not the time. There is a time and place for higher leverage deals for those that are willing to accept the risk. But usually that's going to be after a couple years of strong market performance. Right now, I wouldn't do anything that allows you to build or buy a deal for greater than uh, 80% leverage. Really, I think the healthy place to be is going to be between 65 and 75% loan to cost or loan to value on the leverage. That's going to be a safe space. Anything higher than that, I would tend to shy away from. So last thing here, takeaways for 2026. Here's what we foresee. It's going to be a good year for a few things. That's going to be to buy. It's going to be a great buying year if you're in a position and have cash to do so. It's going to be a great year to build and start construction. Now, as far as selling assets that you currently own, if you have assets that you want to get rid of, it's probably not going to be a good year to sell those assets. So if you have financial position to hold on to any assets you have, I would hold on to them for 1 or 2 more years before you decide to sell. The market's probably going to be a lot better for you then. As well as a refinance, especially the beginning of the year, it's probably not going to be the ideal time to refinance. If you have debt that you can extend, I think towards the end of this year and into 2027 is going to be a better time for that. Capital structures, again, I would avoid high leverage. I would put in more equity. The more equity that you have, the more you hedge against your risk. Now, you do reduce your overall potential returns, but I think that's well worth it as far as making sure that your investment is protected. Now, underwriting assumptions, I think that it's going to be pretty reasonable to expect about 3% rent growth over this next year. Most banks, I think, are going to start to decrease their standards down to a 1.2 DSCR and get more comfortable with that, whereas many of them are at 1.25 to 1.3 now. For lease up, if you're new construction delivering this year, you're probably expecting 10 to 15 units per month and lease up, but that's going to increase, I think, towards the end of the year. We're going to see a lot more action happening there. And then exit cap rates. We just had our 214 units appraised in Waco, Texas, that I mentioned at a 5.25 cap rate um, a few months ago. But I think the reasonable expectation for underwriting, whether it's buying something existing that you hope to sell in a few years or you're building, I would expect that 5.25 to 6.25 cap rate, depending on the age and condition of that asset. And again, as we receive lower interest rates, if that continues to trend in the right direction, those cap rates will continue to compress and underwriting expectations will improve. But that's where I would hover based on 2026 expectations. Okay. Well, I hope this presentation has been useful for those of you that are listening to it. I'll take a moment here. We have a few of you that are on the call. What questions do you have? Is there anything you'd like to go through again or review in more detail? Anything other than what we covered? The floor is now yours for questions. All right. Well, sounds like we we don't have too many Too many questions. So, well, again, I hope this has been useful, um, and that we've been able to provide value for those that have participated in today's call. Um, Moving forward, we have a continuation of this series where we do our webinar series every other week. On the 3rd of this month, we are going to uh, we are going to be doing a webinar regarding buying and selling land, how to do so at a profit. And we on the I think the next date here that we have after that, it's not going to be 2 weeks in the future, but it's going to be that third to last week in February. I think it's the 24th is a Tuesday. And that one we're going to be talking about. Ivan, do you have that on hand? I just my presentation went away.
Let me pull it up right now.
Sorry, guys, for some
So
reason.
here on February 3rd, we'll be doing the how to buy land, create value, and sell for a profit. And then on February 24th, we'll do a another webinar here on market selection and how to choose the specific markets where we buy and invest in.
Perfect. Thank you, Ivan. Okay, so outside of that, if you have any questions, want to discuss this further, want to learn more about what we're doing, we invite you to reach out directly to us, and we'd be happy to take that time and have those conversations. So thank you guys. We appreciate you participation and listening. Hope you have a wonderful day.
Thanks. Bye.